Okay, this is Adrian Gerald. I'm your teacher here for Accounting 120, Principles of Accounting, Principles of Financial Accounting. And the book we're going to be using is Warren, Duchak and Reeves, or Warren, Reeve, and Duchak. The edition I'm using right now is the 25th edition. Starting with Chapter 1, we want to talk about the nature, first of all, of business and accounting. Business is an organization that takes some kind of a resource, materials and or labor, and it uses those to produce something. The thing produced could be a product. In this case, in the case I've got here, think of taking yarn, the resource, and the employee's labor, another resource, to make another product, socks, which it can sell to customers for a profit, you hope. The thing could also be a service. In this case, think of an accountant who provides tax services to his clients. He uses his knowledge and his time to provide a service. Doesn't make anything out of yarn or anything else for that matter. There are other businesses called merchandising businesses, like Walmart or Dollar Tree or something, where they take products already ready to sell and they put several of those in one place where it's easy for me to go shopping. Imagine if you had to go to the farm to buy pork, and you had to go to another farm to buy corn, and you had to go to another place to buy beans, and you had to go to another place to buy milk, and you went to one place that made socks, and you bought socks there, and you went to another place. You get the idea. So that's a merchandising inventory, merchandising business, and the thing they sell is the ease of purchasing things. The businesses we're going to study this semester have the goal of making a profit. There are not-for-profit entities, not-for-profit businesses. For example, James Brent College. We don't try to make a profit, but we're going to focus on businesses that are at least trying to make a profit. Whether they are or not, that's a different story. But we'll find out. We'll talk about those a little later. A business, first of all, is an organization. Again, it's a group of people. Usually, maybe a business could be one person. But it's an organization that takes a resource, for example, materials of some kind, and labor. Oh, wait a second. Let's try that again. They take materials and labor in order to produce some kind of a product. Sometimes the thing produced, as I said before, could be a service. Sometimes it's just selling. It's just the ability to buy things conveniently. These are the types of business: a manufacturing business, a service business, or a merchandising business. And those businesses will pretty much cover anything that you can imagine. Any kind of business you can think of, those guys will cover it. Any kind of business that's for profit, at least. Okay, let's talk about the role of accounting in business. Accounting is an interesting profession in that every business you know doesn't need an engineer. Every business you know doesn't need a guy who drives a bulldozer, or it doesn't need a guy who knows how to work textile machinery. It doesn't need somebody who knows how to raise pigs or to grow tobacco or anything like that. But every business needs somebody who can do accounting, because accounting takes raw information that's disorganized and just floating in the air. Whenever a transaction is made, there's a piece of paper or there's a piece of information that needs to be captured. And we capture that information and we organize it. And then we take that organized data and we turn it into useful reports, useful ways to see it and to use it, to understand it. That's accounting. Every business that you see, when you leave your home, headed to school the next time, go by. Just look at the businesses that you pass by. Every business will have somebody keeping the books, so to speak, somebody who does accounting there. Even an accounting business, somebody who offers their services to public clients, which we call a public accounting firm, has somebody in the firm who keeps their books. Accounting information system. This is on page 3 of the 25th edition. There's a little picture of a man looking at a piece of paper and maybe with a laptop on the table in front of him and a cup of coffee or something. But it talks about how you design an accounting system. And an accounting, you take an accounting is an information system that you design this system first by identifying your users. Who are the people that I'm catering to? So, I don't think we need to identify our users quite that carefully, but we identify their users. We assess their needs for information. The customers that we're going to be using in this type of accounting are external users usually. Those are bankers, perhaps. They could be insurance carriers. They could be investors. They could be other people, but people who are external to the business. Those are our customers when we are financial accountants. We design this accounting system once we understand who our users are. We understand what their needs are. We design a system that captures that information and then organizes it and produces reports that they can use. Let's talk about the difference between managerial accounting and financial accounting. As I said, financial accounting provides information to external users, people who are not employed by the business. They're bankers, insurance carriers, investors, as I said, other people that may be involved in that. I mentioned bankers, but lenders, people who are going to lend money or thinking about lending money to the company. People who are thinking about coming to work for the company in a high level capacity sometimes will want some financial information about the company before they come. Managerial accounting provides information to internal users, managers, supervisors, directors, foremen, things like that. Now, the difference between these two is critical. The information we provide internally can be formatted however we want. It can be for any period that we want. It can be based on any set of criteria that we want. But when we're financial accountants providing information to external users, there has to be some kind of a way to make our information useful to someone outside the company. So we need to make it compatible or comparable to other companies. We'll talk about that in a minute. All right, first, before we get there, I guess we'll talk about ethics. And this ethics is a set of moral principles. That's what, if you want to define it as that, a set of moral principles upon which we base our decisions of what we're going to do. This moral basis for our decisions helps us decide what's right and wrong in our understanding of it anyway. So the question to you is, do you behave ethically? I want you to take just a minute. Go ahead and pause the slideshow here and think, do I behave ethically? And then answer the question, have I ever cheated on a test or on an assignment? Sure, most people would say, yeah, I behave ethically. But when you get down to it, there's a point at which everyone almost has deviated from their moral guiding principles. In accounting, we have to be very careful of that, and I can't stress enough the need for you as accountants in the future to be able to withstand the pressure from a boss or from an external user to provide numbers, to provide information that makes them look good or makes the business look good or makes the business look bad if you're trying to save taxes. When in reality, the numbers should really show what they show. Any time that you fudge the numbers, so to speak, you're getting ready for a problem. And there have been some terrible things that have happened because of accounting fraud. Ethical lapses in accounting or anywhere usually involve one of these two things: a failure of the individual's character, or a company culture of greed or indifference. If the company as a whole is led by people who have a kind of a lax attitude towards ethics, by golly, that's going to pervade the company. There have been some huge corporate scandals like that we know about in recent years. Enron, in this case, the investors and others lost $74 billion. Quest was another. Xerox was another. There were several. There have been too many to count right now. And Enron is just an interesting case. It was one of the biggest companies in the world. It was one of the most successful companies in the world. It was named, I think, by Forbes magazine as one of as the most innovative company in the world for 6 straight years before people began to understand that they had been cooking the books. And to be honest with you, their outside accountant was involved. Their auditor was Arthur Andersen was the name of the company, one of the largest accounting firms in the world. And Arthur Andersen, if you may not remember this, if you go back and look at some old Oscar shows, you'll see the envelope being delivered on stage by a guy in a suit, pretty laid-back guy or straight-laced guy. And he would represent Arthur Andersen. They would say, Arthur Andersen, the accounting firm, has, audited these and found these to be accurate and all that stuff. Anyway, Arthur Andersen had a real name, a real, quality in the public's eye as just the top notch, the gold standard in accounting. And they colluded with the Enron executives basically to allow this cooking the books to happen. It was an incredible thing. A very sad day for those of us who were trained at a time when accountants were supposed to be above the scandal type thing. The Sarbanes-Oxley Act, you'll hear about this, was passed in 2002. It takes its name from two of the sponsors of the bill in Congress, and it came about because of the Enron scandal. It created an organization, an oversight board called the Public Company Accounting Oversight Board, and so publicly traded companies now are subject to the rules this board passes. The Sarbanes-Oxley law Sarbanes-Oxley Act placed really tight restrictions on what accounting firms can do when they provide services to publicly traded companies. Now, in this semester, we won't be dealing a whole lot with publicly traded companies. That's more to come later on. The first chapter or two we deal with in managerial, we'll talk about that, and then in intermediate, you'll deal with a lot of that. But things such as you can't use the same accounting firm for more than a certain number of years. The main partners from the accounting firm that are involved with the audit of that publicly traded company have to change within the accounting firm every 2 or 3 years or something, and a ton of other things that just really put the skids on what accounting firms were doing. I guess in a good way, but I'm just really, it hurts me for the profession that we couldn't police ourselves, and we ended up with this kind of oversight by Congress, and then organizations set up by Congress. Hate to think that Congress is overseeing somebody else for ethics, but nevertheless, that's another story. Okay, there are lots of opportunities for accountants in private industry, and that means working not as a public accountant, but working for a company providing bookkeeping or other services. So a bookkeeper. And by the way, Bookkeeper. Isn't that a lot of double letters? Man. A payroll clerk is not a real good name, but a payroll clerk can make $30,000 or $40,000. General accountant, somebody who has a little more training than maybe the bookkeeper, but is can make in the $40,000 to $50,000 range. A cost accountant, budget analyst, and others that have to do with that deal with private industry can make pretty good money, and it's a great career. In public accounting, basically you're going to think about CPAs, certified public accountants, who work for a local firm, a small firm in a small or big town, or national firms or international firms. Arthur Andersen was an international firm. When I took the CPA exam many years ago, before most of y'all were probably born, I began working for one of the big 8 accounting firms. Arthur Andersen was one of the big 8, and those big 8 have now become the big 5, as some of them have bought others who are having financial difficulties or whatever. But the big 5 accounting firms now in existence are those huge international firms. Okay, we're going to talk about the GAAP today, which is generally accepted accounting principles. Now, generally accepted accounting principles are the underlying principles that guide accountants in the performance of their duties, financial accountants. Like I said before, we provide information to external users. So there has to be some way to make the information that one company provides be able to be compared with the information that another company provides. And that's the job of generally accepted accounting principles. This is an important thing, so I would recommend that you have this tattooed somewhere on your body. The forehead is a great place. I'm sure that you won't find it offensive to do that, but it's a joke. But you need to understand what generally accepted accounting principles are. They're the principles upon which the rules that we follow are based. Not this kind of a principle, but the principle, a fundamental truth, a proposition that serves as a foundation for a system of belief or behavior in this case. An example of a principle is honesty is the best policy. A rule based on that principle is never commingle your funds, never mix the money that you have with the money of your client. Never do that. Anyway, that's a rule. But if you understand honesty is the best policy, sometimes you don't need all the rules because you understand what honesty is to begin with. Generally accepted accounting principles are determined by the Financial Accounting Standards Board, known as FASB in the United States. Internationally, GAAP is set by the IASB. Guess what? International Accounting Standards Board. Generally, the U.S. GAAP is more rules-based than international standards, which is more principle-based. They are different in a lot of areas. They are coming together. They're converging on the same point, slowly but surely. And to be honest with you, the U.S. is a leader in the world in accounting standards and accounting theory. And the IASB is gravitating more towards the U.S. Standards than the other way around, but they're both moving. Let me just say that the accounting profession moves slowly, and you might say glacially. Man, I got to tell you what, it takes a while, but it comes around eventually. Okay, we want to talk about the business entity concept. An entity is an individual. An entity is something that acts for itself. A person is an entity. A business is an entity. It's separate from the guy who owns it. You need to really review this again. The funds of the business, the money that the business has, the assets the business has, are different, separate, distinct from the owner. The owner and his assets and his transactions are not the business's transactions. They are not the business's assets. The business records only the transactions that directly affect it, not the transactions that affect the owner personally. For example, if the owner takes personal funds out of his personal bank account and buys a boat, it has no effect on the company. The company makes no entry here. It has no information to capture. There's nothing that has happened within the company. Different thing. The owner is not the company. Okay, so let's say the owner borrows money from a bank to buy a boat. Again, no effect. The owner borrows the money on his own from the bank. No problem. Okay, the owner, in the third case, withdraws money from the company to buy a boat. In this case, there is a transaction. The company has given money, part of the equity of the company, to the owner, and that's totally legal, and it records the withdrawal of those funds, but that's it. It doesn't record the purchase of the boat. The boat has nothing to do with the company. So you don't want to make any you don't want to record any transaction that's not part of the business entity itself. Types of business entities. There are sole proprietorships. That's one person owning a business. 70% of the businesses are this type. Partnerships. This is let's go back again. A sole proprietorship is easy to set up. You can set it up in a minute. You can say, I'm a business. It's just about that simple. You need to get a license and a few other things, but you can be a business in 10 seconds. A partnership is is almost like a sole proprietorship, except two people or more are the partners. Could be hundreds, in fact. And some of the large accounting firms, there are thousands of partners. But a partnership is more difficult to set up. You have to have special legal arrangements because each person owns some part of the equity of that business, some part of what that business is worth. And so when you separate, say, an owner from the business, one of the partners decides to leave, or he doesn't decide to leave, he dies suddenly, there has to be some way to make that to make the partnership carry on. That's one of the most difficult things about partnerships is making it continue on past the first generation of partners. A corporation is different. A corporation is a separate legal entity. It's set up as a legal entity. It can't vote, but it can pay taxes, that's for sure. The first two don't pay taxes. A sole proprietorship files a tax return for information purposes. So does a partnership. And then the owners pay taxes on their part of the income. A corporation is different. It pays taxes on its income. It also shares that income with the owners, and there could be thousands, millions of owners of a corporation. When you buy stock, you're buying a share of stock, and it's a piece of ownership of a corporation. A corporation might issue 10 million shares of stock, and if I own 5 shares of stock, I own 10 millionths of the equity of that company. But I can sell that stock to somebody else, and if I die, that stock doesn't go away. It's left to my heirs, and so the corporation just lives forever without regard to what happens to the individual people involved. They're only about 20% of the businesses, but they generate 90% of the business revenue. The reason for that is that a sole proprietorship has limited resources. It has only the resources that the one owner has. The partnership has only the resources that the different partners have. A real quick note there: usually in a sole proprietorship or a partnership, if the company itself is sued and has some huge award that it needs to pay to the plaintiff, then the owners are liable for that in most cases. In a corporation, that's not the case. I can own GE stock or some stock in a smaller company, and if that company does something screwy, the only thing I can lose is what I've paid for my stock. The company could go bankrupt, but nobody's going to come to me and say, hey, you got this big cash award that you're going to have to pay, so pony up. So limited liability is one of the hallmarks of a corporation. And there's a new thing called, fairly new, LLCs, limited liability companies. usually a subset of corporations or a subset of partnerships, and they're about 10% of the businesses. Getting more popular, but still corporations are the way to go if you're trying to raise capital to produce large amounts of anything. Imagine, for example, trying to start a company to build a car. How much money would it take to acquire the location, to buy the machinery, to train the employees, to get the materials? How much would that cost to build a car? To design? How much would it cost to design the car? A few people can't do that. Maybe a multi-billionaire could, but it would bankrupt him probably if he weren't successful. But a corporation can be formed, and everybody, thousands and thousands and thousands of people buy stock in it, and that's all that money goes in and is used for purchasing the materials and the location and the et cetera, et cetera. Okay, the cost concept, critical here. Everything I've talked about is going to be on the test, so don't forget to go back and read the chapter. The amounts that we enter in the record of the company are at historical cost. That means whatever the cost was at that moment, how much money changed hands, basically. If you have a car that lists for $20,000 and it sold, I bought it for $18,000, I'm going to record it on the books of my company for $18,000, not $20,000. In the book, they mention a house. And you'll see an example just like this on the test, just exactly like this example. And the price listed by the seller on January the 1st, 2012 was $160,000. They offered to buy the not a house but a piece of property for $140,000. The purchase price they actually paid for it was $150,000. The estimated selling price 2 years later, they think, is about $220,000, and the value for property taxes is $190,000. What are you going to record it on the records of the company? You're going to record it for $150,000. That is the only number you need to know out of all those numbers. How much money changed hands? What was the purchase price? The estimated selling price is what you think it's worth now. That's the estimated. If I sold it now, I could estimate I could sell it for $220, but that's not what I'm going to record on the records. Now think about an asset you've owned for a while. Now we're not going to talk about depreciation for a couple of chapters here, but imagine this car instead of this car. And list price was $40,000 when I bought it. The purchase price, after I dickered with the dealer, was $35,000. I've used it for 15 years, and it looks like I've used it well. It's still in service, and the current Blue Book value, if I could sell this thing, was probably $800. So what am I going to record it on? What is it going to be recorded at right now on the records of the company? And the answer is $35,000. All right, we want to talk about the accounting equation. This is another tattoo for you. The accounting equation is this: assets equals liabilities plus owner's equity. Assets are things you own. I want you to think about the things that you own yourself. You own maybe a computer. You own probably an expensive accounting textbook. You own a calculator. Some of you students who have been out in life for a while may own a home. You may own a car. You own clothes. You own a television. You own books and pots and pans and all those things. All those things are things you own. Liabilities are the things that you owe, the amounts you owe to other people. When you buy a house, you may put down 20%. Say you have a $100,000 house and you save up and you put a 20% down payment down. That means you've paid $20,000, but you owe $80,000. So I have an asset that's worth $100,000. That would be on the left side. My liabilities would be $80,000, and my owner's equity would be 20. That's how much equity I have in that house. The same works for a business. The assets equals the sum of the liability and the owner's equity. Now you can change this around, and not if you want to. I want you to keep this in your mind. I'm going to show you it a different way, just for algebraic purposes, and because sometimes we're going to have to be thinking about these things and determining. We know what owner's equity is, and we know what assets are, what's liabilities. I want you to think about it again. Assets equal liabilities plus owner's equity. Owner's equity is made up, for our purposes right now, of revenues and expenses. The company earns revenue, that increases owner's equity, and expenses are incurred in order to generate that revenue, and that decreases owner's equity. But it's the net amount then, hopefully a positive amount, which would be net income, increases owner's equity. But assets equals liabilities plus owner's equity. We just don't want to get away from that. We need to know that backwards and forwards. Sometimes you can restate it. You can say assets minus liabilities equals owner's equity. Now you could say assets minus owner's equity equals liabilities. But it's very important that you remember the original equation. Assets equals liabilities plus owner's equity. And that's going to become important, obviously important in just a part of a chapter or two. Okay, the accounting equation must balance. The dollar value of assets recorded must equal the dollar amount of the liabilities and the equity recorded. If you have an airplane, you want that thing to balance. You want the left wing to weigh as much as the right wing. So the assets, let's say we recorded assets worth $10, and we recorded liabilities worth $5, then equity must be $5. It's got to be. This equation has to balance with every transaction we make. But if we mess up, if we take our eye off the ball and we record something wrong, let's say we record $10 worth of liabilities and $5 worth of equity, but only $10 worth of assets, look at the airplane. What's going to happen to that right-hand wing over there? Yeah, it's going to dip down and fall out and crash and burn, and you're going to crash and burn too. So whenever you're making an entry, you think about that equation. The left side of the equation has to balance with the right side of the equation in every case. Assets equals liabilities plus owner's equity. If it's out of balance, it is wrong. The accounts will be out of balance, and your books will be out of balance, and your grade is going to be going down. So we don't want to do that. We want to make sure our accounting equation stays in balance all the time. Thought of another way, assets is the sum of owner's equity and liabilities. If you look at it as a pie chart, in this case I have $50,000 worth of equity and $50,000 worth of liabilities, so I've got $100,000 worth of assets. If I have another situation, I have $75,000 worth of liabilities, $50,000 worth of equity still, so I have $125,000 worth of assets. It's got to be this way. It's got to be balanced. If I have $75,000 and $25,000 liabilities and equity, I've got $100,000 worth of assets. It doesn't matter what the numbers are, they have to balance. And finally, I put down $200,000 worth of liabilities, a little piddling $25,000 worth of equity, so I have $225,000 worth of assets. I must have the balance. We're going to talk about financial statements just very quickly. The income statement. Revenues and expenses are netted against each other. Revenues being positive for equity, expenses being negative for equity, and then the difference helps us to arrive at net income or net loss if we've not made money. And then this matching concept. You're going to hear this a lot, and you're going to have to know this like the back of your hand. It's a principle. The matching concept means that we match expenses and revenues to the periods in which they are generated or incurred. And we're going to talk about this at some length in another time. But just remember, if I incur an expense in this month, I'm going to record that expense in this month, even if I don't pay it right now. For example, I could buy materials. Say I'm a merchandise company and I'm buying shoes to sell. I buy those shoes and they arrive at my door the last week of July. I don't have to pay for them for 90 days. I don't have to pay for them until October, the last of October. But those shoes are mine. I haven't had a transaction. I haven't traded any money, but the transaction is that I have traded a promise to pay, or a liability in this case, for this asset. So I've increased my assets by whatever the value of the shoes are, and I've increased my liabilities by whatever the values of the shoes are in the current period. If I sell some of those shoes, I'll increase my cash by whatever I brought in. I'll decrease my shoes by whatever the amount is that I sold, and the difference will go into owner's equity. So it's always going to be in balance. And you're going to do the income statement first. Always the income statement first. Second, you'll always do the owner's equity, the statement of owner's equity. It must be this way. You cannot do it in any other order. It's impossible. Income statement first, statement of owner's equity second. And the statement of owner's equity shows the changes in owner's equity during the current period. So both of these statements up here, the statement of owner's equity and the income statement, are for a period of time, a month, a year, something like that. Usually we're going to see them as a year, and we'll put the date as for the year ended 12/31/2013. The balance sheet, however, is like a flash bulb going off. Just imagine yourself in a very dark room, and the only thing you have to see with is a flash on a camera. It takes several seconds for that flash to regenerate, and so you press the button and you have just an idea of what's in the room, but some of those things are moving, and you take another flash in a few seconds and you see where those things are then, but you don't know what they've done in between time. The balance sheet is like that. It's a flash of time, a moment in time, just a split second, and usually the close of business on the last day of a year or a month or financial period. And a balance sheet shows the assets on one side and the liability and owner's equity on another, and generally. The book talks about statement of cash flows, and we're not going to talk about a statement of cash flows. We're not going to deal with that very much in the course. I'm not going to ask you to understand that and to know that. I want you to look in chapter 1 on page 17, and I want you to get really comfortable with the way these income statements, the balance sheet, and the statement of owner's equity look. You don't have to worry about the statement of cash flows. But you're going to have the company name at the top of the heading. You're going to have a 3-line heading every time. You're going to get used to putting a 3-line heading down with the name of the company first, the name of the statement second, income statement, statement of owner's equity, balance sheet, and then you're going to have the period or the date. For the first two, it's going to be a period of time. In this case, on our page here, for the month ended November 30th, 2013. For the month ended November 30th, 2013. And for the balance sheet, it says just the date, November 30th, 2013. So at the close of business on November the 30th, 2013, that's what the balance sheet shows, a moment in time. That's all you're going to see. We're going to get together in class now, and we're going to do a few problems. I think it would be great if you read the chapter, please, and be looking at the practice exercises as you go along. As you see on page 8, if you'll quickly look at page 8, you'll see a reference to a practice exercise, practice exercise 1-1A and 1-1B. Those are on page 28 of the chapter. You turn over there. When you've done that concept through page 8, go ahead and go over to these two practice exercises and do them. They take a minute, and just work through the chapter like that, and that'll show you where your problems are and what you need to review again. But thank you very much, and I look forward to seeing you in class.